So look, this chart is pretty depressing. So that's a pretty big dip. Doesn't mean that people with fewer years of experience are not still getting interviews. They are. Layoffs are still happening. Hiring is down. So not just FANG level companies. We have reason to be optimistic because history doesn't exactly repeat, but it does rhyme. And I think right now it is rhyming. Welcome, welcome, welcome. Today we're going to be looking at the state of the hiring market in tech. And as such, we're going to be answering three questions. The first question is, what is the state of the hiring market for developers? The second question is, what is the state of compensation for developers right now? And the third and final question is, how does this downturn compare to previous downturns like the dot-com crash? And so what I'm going to do here is I'm going to look at a variety of data sources, and we're going to dig into some numbers to kind of paint a picture by numbers. I want this to be a data-driven answer to those three questions. And I'm also going to give you my read of the data and of the market more broadly so that you can walk away with a sense of what is happening right now and maybe what you might need to be doing differently. Okay, so without further ado, let's start with the first question, which is, what is the state of the hiring market for developers right now? So the first thing we're going to jump into here is data from the St. Louis Federal Reserve. Okay, so as I said, this is a chart from the St. Louis Federal Reserve looking at job postings on Indeed in the United States. And before we jump into these numbers, a few call outs, right? So the first is that this data is indexed to February 1st, 2020. So what does that mean? That means that February 1st, 2020 is our baseline against which all these other dates are compared. So if there were, for example, 1,000 job postings on February 5th, 2020, right, we are over 2x that by February of 2022. So again, this is a relative chart indexed to a specific date. One last thing to mention here, February 1st, 2020 is really, at least in the US, was before the world economy kind of ground to a halt. So I do think it's actually a good date against which to compare. So let's dig into these numbers, right? So this chart goes all the way to December 29th, 2023. So that's the last date of data that we actually have. And if we focus on this part of the chart, we can actually guess what happened, right? This is COVID. This is when companies began doing layoffs, hiring freezes began, a lot of offers were rescinded. And we see this kind of touch a bottom of about 63. So again, this is a relative measurement, right? We're comparing against February 1st, 2020, which means that there were about 40% fewer job postings on Indeed a few months after February, so May of 2020. We then see things begin to pick up speed in December of 2020, and we see it peak between November of 2021 and let's say July of 2022. So this was the hiring peak. And so let's look at the data right now, right? So we have data from December, we said, November, December 29th, 2023 is the last date. And we see that we're hovering around 74. So that is a little better, right, than this trough right here, which was around 63. But again, this is a relative scale, so we're comparing to February of 2020. So what conclusion can we draw from this, right? We can say that hiring, at least from this data source, would indicate that we're doing maybe a little bit better than we were when the world economy shut down. In other words, it's pretty bad right now. So like I said, we're hovering around 74, 75 on a relative scale compared to a bottom of 63 in May of 2020. So look, this chart is pretty depressing. And if you're thinking that, or if you're agreeing with me, I don't blame you, but I do think it means that we can really only go up from here. Just want you to keep in mind, right, this is one data source. This is job postings on Indeed. I would say most developers probably don't find their work through Indeed. I would imagine most people apply through LinkedIn, but I'm not totally sure. I don't have the data on that. So again, there are limitations to this data, but I do think it is broadly representative of what's happening in the market right now. Okay, so now what is this chart? Right now we're looking at the S&P 500 on the NASDAQ's website, and what we see, right, is we see a bottoming out of the market in about March of 2020. That is kind of close to what's happening in this chart right here, right? Maybe it's actually the hiring market maybe took a little more time to respond, but it broadly traces this chart right here. We see the market kind of peaking around December of 2021, January of 2022. And so now if we look back at this chart, we see the market peaking in the hiring market, right? Peaking in December of 2021 all the way to about May of 2022. So the peak for the hiring market lasted a little longer than the peak in the public markets. But what happened is that we saw a pullback, right, in the S&P 500. And that is about when we start seeing this decline in job postings on Indeed. I'm making this comparison to highlight that what happened, right, these past 2 or 3 years in the hiring market closely tracked what was happening in the public market. One last data point here. Carta, which is an equity management platform, released a report on kind of the state of startup compensation for the first half of 2023. And they said this. They said that startups on their platform in the first half of 2022 hired 314,000 people. And for the first half of 2023, that figure of people hired fell to 129,000. So that's a pretty big dip. To quantify it, that's a dip of about 60%. Okay, so we just looked at job postings, keeping in mind, right, this is one data source, but next we're going to be looking at layoffs. I want to drill into some numbers here to paint a broader picture. And we're going to go back to that report that I mentioned from Carta, right, which looked at the state of startup compensation in the first half of 2023. And one quick note here, I am not sponsored by Carta or any of the other sources I'll be working through in this video. I just chose them because I thought they were good reports with good data. Okay, so here is the report. State of Startup Compensation, H1, which stands for the first half of 2023. So we're not going to walk through all of this, but we are going to jump to a few key charts and graphs, and I just want to highlight some takeaways from the data. Let's look at this chart. Which tracks employees leaving their companies monthly across all Carta companies from January 2019 to June 2023. So that covers, of course, the COVID contraction. We see a spike in layoffs, again, due to the shutdown of the global economy, right around March and April of 2020. Then we see kind of a flatlining of that during the hiring craze all throughout 2021. And then we see in 2022, right, a spike in layoffs. And that actually lines up with around when the Federal Reserve began raising interest rates. So that was in March of 2022. So the main takeaway here is that layoffs are happening, but not at the pace that they were maybe 6 months ago. So again, this is covering the first half of 2023. I don't have the data on the second half of 2023. I'd be curious to see what it looks like. So I'm going to jump to another chart here, which is net headcount across Carta companies. And the takeaway here, right, is that headcount has fallen. So we see a reduction in net headcount, which is to be expected given the data we just looked at. And I would say this chart right here kind of tracks this spike in hiring, this spike in job postings we saw on Indeed, right? So these look pretty similar. So we looked at some depressing things, right? The decline in job postings, the rise in layoffs. The next thing I want to look at is maybe a little more upbeat. We're going to be looking at where hiring is actually happening in the tech market right now, specifically, again, for developers. And to do that, we're going to be looking at a report from Hired, which is a job search marketplace. Again, I'm not sponsored. I just thought it was an interesting report with good data. Just a kind of quick intro on this report. This is a report entitled 2023, The State of Tech Salaries, the Tech Hiring Tightrope. So first thing is we're going to jump here to slide 21. What are we looking at here? We're looking at active position share by market cost of living. So what that means is basically job openings or job postings by cost of living market segments. So a high cost of living market, a medium, and a low cost of living market. What I would be curious to know, and I couldn't find it in this report, is what is defined, right, in each of these segments. So which markets are high cost of living, which ones are medium, and which ones are low, because different people define that differently, right? And that can kind of impact how this data is shaped and how it appears in this chart. So If anyone from the hired team checks this out, I would be curious to know how this split was made. What do we notice from this? The first thing, I want to make sure my head's not covering this, but so the first thing we see is that there's been a decline in active positions in high cost of living markets, and I would say actually a pretty significant decline. So a little over 75% down to, I'm guessing that would be like 65%. We've seen a slight gain in the number of active positions, or the share rather of active positions in medium cost of living markets. And we see a really big jump in active positions in low cost of living markets. So just an interesting insight. So jumping over to the next slide, which is slide 22, this actually doesn't have any charts, but it does have a few interesting tidbits I'd like to call out. So the first one, if we zoom in, is right here. Large enterprise companies reduced roles open to remote by 32% from 2022 to mid-2023, and small businesses increased remote availability. So that actually tracks with what I've been reading and hearing from people, anecdotally at least, that large companies have done a big push for return to office, and smaller companies either remain flexible on remote or have increased their remote availability, as it says here. This is maybe a little less relevant, but I do think it's still interesting. After peaking at an average of about 4.7 markets and 2.1 average number of time zones in 2022, companies are interviewing in an average of 3.2 markets and 1.7 time zones in mid-2023. That could tell me a few things. The first is that maybe companies are just looking for local talent the way they were prior to 2020, or companies that are still looking for remote are just looking for people that are aligned with the company's time zone. Okay, last chart I want to look at in this report is on page 17, right? And it is this chart right here. I'll make sure to zoom in. So right here, we're looking at interview requests by years of experience in 4 bands, right? 0 to 4 years of experience, 4 to 6, 6 to 10, and 10 plus. So I am going to have to actually assume in this chart that it is not inclusive of this 4. So we're really looking at 0 to 3, and then 4 to 5, and then 6 to 9, and then 10 plus, because otherwise there would be overlap in this data. What insights can we glean from this? So the first thing I'd say is that, of course, there's been a really big decline in early career developers, right? So people with up to, let's say, 3 or 4 years of experience have seen a significant decline in the share of interview requests that are going to them. What we see for people in the second band up, so these might be mid to senior level developers, those with 4 to 6 years of experience have seen what looks to me to be about the same share, maybe a little more, of interview requests. And then we see a big jump in the share of interviews going to people with 6 or 7 or more years of experience, right? So that is the yellow right here and the red right here. I'd say there are 2 main takeaways, at least from the 3 slides we looked at. The first is that hiring is still happening, but it's happening at smaller companies and in lower cost of living markets. And the second is that the people getting interviews tend to have more experience, so 6 or more years of experience. That means that the market for early career devs, right, people with 0 to 4 years of experience are just seeing fewer interviews going their way, but that doesn't mean they're not seeing any interviews. So we just answered the first question, right, which is, what is the state of the hiring market for developers? And I think we got some pretty good data. Now we're going to move on to the second question. And the second question is, what is the state of developer compensation? And we're going to be looking at 3 reports here. Again, I'm not sponsored by any of these companies. I just think they offer up great data. Okay, so we're going to go back to the Carter report, right, which is the state of startup compensation for the first half of 2023. And so to give you a sense of just how robust this data is, I'm just going to draw you to this sentence right here, which is that compensation report is drawn from more than 280,000 employee records from startups that use this company's product. So what are the takeaways from this Carter report? The first one I've already mentioned, right, which is that first half 2022, 314,000 people were hired, and that figure fell to 129,000 during the first half of 2023. Again, I'd be curious to see what this data is for the second half of 2023. The second is that salaries have flatlined to start the year. So the compensation benchmarks for employees fell 0.3% year over year. The other is that equity packages saw a substantial reduction. So over the November 2022 to May 2023 timeframe, average equity grant benchmarks declined 26%, which I think is pretty significant. So first chart I want to draw your attention to is this one, right, which looks at the median salary by function. Again, we're looking at startups, so this is data from the private markets. So if we look at kind of engineering specifically here, we see that it's gone up, although marginally from April 2022 to May 2023. It rose just a little bit across, again, this is all of engineering, all roles, all levels. And then if you're curious, you can look at the data in other functions. So we see some declines in data and design, HR, customer success, marketing, and operations. But overall, I'd say compensation is flat to down across all functions at startups in 2023 or the first half of 2023. Next chart I want to draw your attention to is this one, right? So the salary and equity benchmarks at startups from November 2022 to May 2023. Again, we see this decline in equity of 26%, which I mentioned earlier in the report. And then we see here the 0.3% decline in salary. The next report I want to look at is from Levels.fyi, their end-of-year pay report for 2023, which has some great data. And there's a lot of stuff in here. I'm not going to dig into all of it. I actually just want to focus on this slide right here, which is page 2. And what we see is that there has been an increase in median compensation for software engineering management, right, of about 2.16%. And then we see a decline of about 0.57% for software engineers. So that tracks with the data we just looked at from Carta. And again, this is actually data across, I think, private and public markets. So it's maybe a more holistic picture of the state of compensation for developers. So the next thing we're going to do is we're going to jump back into that hire report, which we looked at earlier. And I just want to make a few call outs here. So the first one is that U.S. tech salaries have seen the largest year-over-year decline in the past 5 years. And when adjusted for inflation, so that's key, right? U.S. tech salaries have dropped to their lowest point during the same period. So that also tracks with all the other data we've seen. Second point I want to call out here is that engineering managers commanded the highest salaries in both the US and the UK, so at least we have an international market here, while engineers with specialized skills in AI, security, data, and machine learning showed the most demand. That also makes sense, given what we've seen this year. So now we are on their page 5, and I want to highlight this point right here, which is that in the U.S., inflation-adjusted salaries are down 6% for remote salaries and down 9% for local compared to 2022. That I find interesting. I would intuitively expect remote salaries to be down more than local salaries because I think it's harder to find local talent than it is remote talent. So curious why that is. If any of you have insight, I would be interested in hearing why. But I do find that point kind of counterintuitive. Next chart I want to look at on this slide specifically is local and remote salaries, inflation adjusted. So that's key because a lot of the data we've been looking at previous to this has not been inflation adjusted. So it's data in real terms. And what we see here, right, is that in 2023, if you account for inflation, $156,000 feels like $129,000. For remote roles, $161,000 feels like $134,000. We see a pretty big decline in 2022 as well, and then in 2021, which I think is when inflation kind of started taking off. So jumping to slide 6, I want to read this bit right here, which says, salary expectation listed on job seekers' hired profiles, keeping in mind, right, that hired is a job search marketplace. have remained relatively flat despite inflationary pressure. So it seems like people who are looking for jobs recognize that salaries aren't what they once were, at least compared to maybe 1 or 2 years ago. And the next point here is, right, likely a combination of candidates across more markets and expectations lowering as they're more willing to take opportunities given lower demand. So just interesting tidbit there. Last thing I want to call out in this hired report is that the more experienced, the less salaries decreased. And that actually also tracks with that chart, if you remembered, we saw in Carta's report around the share of interviews that were going to people with more experience. So there's more demand for more experience. That's basically the takeaway. And that's reflected in salaries here. Okay, so we just answered the second question in this video, which is, what is the state of developer compensation? And now we're going to answer the third and final question, which is, how does this downturn compare to past downturns? And specifically, we're going to look at the dot-com bubble. So how did I answer this question, right? So I looked at a variety of sources, not just reports, but also books and journal articles. And what I want to do here is draw a few parallels as well as a few differences to what we're seeing right now. And I think there are some really interesting points to be made. So to start out, we're going to look at a chart that tracks the share prices for the NASDAQ and the S&P from that time. So again, we're talking about the dot-com bubble and the recession that followed. This is looking at the S&P 500 and the NASDAQ, which was tech-heavy then and is actually still tech-heavy now. And we see that the NASDAQ peaked around the first half of 2001. There was a pullback, a bounce, and then a really, really big decline, all the way up to the trough, which is second half of 2002. S&P also followed a decline, although it wasn't as drastic. Again, that's because the NASDAQ was and still is very tech-heavy. So that is a really scary chart to look at. And it's scary because the NASDAQ declined about 80%, and it didn't fully recover until about 2016. So if you had bought at the peak here, you wouldn't have really made your money back until about 8 years ago. Because we saw, right, a huge drop in the markets, of course, a lot of companies went under, there were a ton of layoffs, a ton of contractions, and that resulted in an uptick in unemployment. So if we look at this chart, which looks at the unemployment trends from about 2000 to 2007, we see that there's a fairly significant rise in unemployment for IT occupations, as well as a rise for all occupations. But IT or tech was hit particularly hard. And the dot-com bubble was so bad, in fact, that it actually led to a decline in the number of people pursuing CS degrees. So I actually pulled an article from a professor of computer science at Stanford, Eric Roberts, and he looks at the history of enrollment in computer science. So let's jump into that data right now. One chart from his paper that I want to look at is the number of bachelor degrees in the U.S. for computer science. I want to ignore actually this blip right here in the 1980s. I'm going to talk about that momentarily. But right here, right, we see a fairly big decline beginning in 2004, and we see it bottom out around 2008, 2009, which is when the great financial crisis happened. And then we see an uptick, and if that chart could be extended, that would continue rising because there's only been greater interest in pursuing this degree at the undergraduate level. One thing I want to call out, because I find it personally fascinating, is that there was actually what I think fairly significant delay between the dot-com bubble and the decline in the chart we're seeing here. So again, that bubble burst in 2000 and the market bottomed out around 2002, but we don't see the decline really pick up speed until about 2004, 2005. So it took a little bit of time to work its way from what was happening, right, in public markets to what was happening at the undergraduate level. One last thing I want to look at in this journal article is that Eric Roberts, right, the author, tries to explain why it took so long for interest in computer science to resume. The key parts are right here, which is that a meme arose, right, in the form of a widespread belief that computing jobs were in danger of imminent collapse, either because they'd be automated out of existence or because all software development jobs would be shipped offshore. Although there was no evidence to justify those fears, that mythology kept students out of computer science until disaster struck in a different sector of the economy, which is in reference to the great financial crisis of 2008, 2009. The interesting part to me about this is that I find these sentences equally applicable to today, right? So I do think there is a fear around automation, specifically due to generative AI, and there is some fear around offshoring as well, which anecdotally some people say is kind of already happening at the startup level. So interesting that the fears then are really the same fears today. One last point before I forget. So I said I was going to explain what happened here in the 80s, which I find to be historically fascinating, right? So there was a fairly significant decline in enrollment in computer science degrees beginning in about the mid-1980s. And it kind of bottomed out around the early to mid-90s. And the reason for that is because universities could actually not find enough faculty to teach the subject. And because they couldn't find faculty, they limited enrollment. And because enrollment was limited, we see this decline in the number of bachelor degrees that were issued. So the dot-com bubble crisis and the recession that followed was a period of a lot of doom and gloom for the tech sector. A lot of people thought that tech would never recover, that hiring would never be the same. And I will say that actually hiring did recover, and it actually recovered more quickly than people thought. Hiring in tech had basically recovered in 2004, and there is actually data on this. So in Seattle and New York, for example, the total number of people employed in the tech sector actually exceeded what it was at the peak of the dot-com bubble in 2000. So I would say a period of 3 to 3.5 years is a fairly quick turnaround for a crash that a lot of people said was fairly catastrophic for the tech sector. But again, there were second and third order effects from that, like the decline in enrollment in computer science at the undergraduate level. So the last thing I want to leave you with here is I want to draw a parallel between what the sentiment was then and what the sentiment is now. So I frequent a lot of the subreddits and forums and apps that people look at like blind, and there's a lot of doom and gloom, and it's understandable, right? Like what's happening in the market is scary. It's covered incessantly. There have been really high-profile layoffs, and so I understand and I sympathize with people who are feeling uneasy right now. But I want to show you that same fear, that same catastrophizing was happening in the early 2000s when the dot-com bubble burst. So to prove to you this last point, right, around the doom and the gloom and the catastrophizing that was happening, I pulled a magazine called Computer World, which covered the tech sector. And believe it or not, this publication's actually still around. So let's kind of quickly scan this magazine. Just a few quotes right here. The first, most firms, even those experiencing layoffs. Oh, I should note, this is from January 7th, 2002. So it was pretty bad, right? The market was beginning to bottom out. At least the NASDAQ was beginning to bottom out around this time. So this first quote right here, right? Most firms, even those experiencing layoffs, will still need good people in key areas. Target good, solid firms that are more likely to be around providing jobs in the future. I'd actually say that's still applicable to, and that is advice I would give about what is happening right now. This is a kind of telling quote right here. We have a weak economy, terrorism, the burst of the dot-com bubble, and the internet infrastructure bubble, and new technologies that are not well understood all at the same time. That is unprecedented in my lifetime. I wonder what they would say about right now. Another quote, right? The year ahead may be a long one for job seekers, especially if the recession gets worse. Patience is required as the pace of employer decisions will be slow. I'd also say that is applicable to what's happening right now. And then, of course, they give you some advice, right? Stay put, get training, reach out. making the best of a bad market. I don't know. I thought this was interesting and telling because you could almost say this was written for today. A lot of these same statements apply to the current market we're seeing in tech, but there was a lot of doom and gloom, and a lot of people said that tech would be really slow to recover, and in some ways it was, but in other ways it wasn't, right? So because hiring and staffing levels had kind of exceeded the peak of 2000 by around 2004. Okay, that was a lot. At least I think it was. And if you've stuck around, thank you for sticking around. But for those who want the TLDR, for those who want the conclusions without digging into the data, for those of you who have skipped to the end of the video, this is for you, because I'm going to basically distill everything we've learned, all of the insights we've gleaned from this data into some key takeaways and conclusions. So I think the first key takeaway here is that layoffs are still happening, although maybe they're not happening at the same elevated pace that we saw in 2022. There are some limitations to the data. Of course, we don't have a lot of data for the second half of 2023, but the conclusion is that layoffs are still happening. The second takeaway, I think, is that hiring is down, and it's down in a big way for startups. It's down up to 60% compared to 2022, which is fairly significant. And I would say anecdotally, the same is likely true for public companies. The third takeaway is that salaries are down about 5 to 10% across all markets in the US, although hiring is still happening in lower cost of living markets and at smaller companies. Hiring has really slowed down at some of those larger companies. The fourth takeaway is that people with more experience have seen a smaller reduction in salaries and are getting more of the interviews. So it seems like companies are really looking for people with 6 or more years of experience right now. But again, that doesn't mean that people with fewer years of experience are not still getting interviews. They are, but comparatively, they're getting less than they used to. And the fifth takeaway, and I think this actually might be the most important one, is that if we compare this current market cycle, so not just what's happening in public markets, but what's happening to hiring, if we compare that to the dot-com era where the NASDAQ fell like 80%, we have reason to be optimistic because hiring had basically recovered by 2004, 2005. And remember, the bottom of the market was around 2002. So I think that's a fairly quick turnaround. In about 2 or 3 years, the market in the dot-com era had almost fully recovered from a hiring perspective. So those were kind of the 5 conclusions, right, from all the data we looked at. But I do want to leave you with some parting thoughts here. The first, as I mentioned, is that I'm not an economist. I'm not a forecaster. I tried to draw what insights I could and shared them with you. I hope they're instructive in some way. The second is that history doesn't exactly repeat, but it does rhyme. And I think right now it is rhyming. The other thing I'd say is that tech is highly cyclical. I've said this a number of times. So this is to be expected, right? These downturns, which in some cases are extended downturns, do happen. But the market and tech has historically bounced back. And tactical advice I would give to early career developers is keep working on projects, contribute to open source if you can, polish your interview skills, polish your resume, rework it as many times as needed, and be flexible about the kinds of positions you're considering, right? So there may be some tech adjacent roles that can serve you in your career, and also be flexible about the kinds of companies you're considering, right? So not just FANG level companies, but a lot of Fortune 500 companies have a need for developers, for really talented developers. Sometimes these companies are not necessarily tech first, but several aspects or all aspects of their businesses are tech-enabled. So there is a need, and there will continue to be a need for developers. So I would tell people to be flexible in their approach and be flexible about the kinds of positions they're willing to take. Thank you so much for watching. I hope this was instructive. I hope it served you in some way. I hope you learned something. I know that I did. I learned a lot in doing the research for this video, and I hope that comes across. And if I missed any data, please let me know in the comments. I'd be interested to hear what I missed, what I could have added to make this more useful for you. And if you've stuck around, thank you. I really do appreciate it. And I hope to see you in the next video.